Credit scores look like math, but behave like psychology. They're sold to you as a judgment on character, a three-digit moral score that decides whether you deserve a home, a car, a job interview, a lower insurance premium. Banks and lenders are not villains, they are businesses that price risk. But the system they built rewards certain habits, punishes others, and hides a few levers in plain sight. If you learn how the machine sees you, you stop feeling lucky or cursed by a number. You start steering it. This is not a list of hacks. It's a translation guide. How credit models think, what lenders really care about, and the quiet moves that shift your score from a fragile gatekeeper to a tool that lowers the cost of your life. Begin with the most uncomfortable truth. Your score is not your worth. It is your predicted likelihood of paying as agreed in the next 2 years. Models don't read your intentions, your character, or your worst week. They read behavior recorded by institutions in a language called data. The dominant models focus on 5 inputs, but the weight of each is not a secret so much as underappreciated. Payment history is the bruiser. Missed and late payments hit hardest because yesterday is the best predictor of tomorrow. Utilization, the share of your revolving credit you're using, is the fast-moving barometer. High balances relative to limits look like stress. Age of credit history is your reputation. Older, well-kept accounts present as stability. Mix of credit signals your ability to handle different kinds of obligations, installment loans and revolving lines. New credit inquiries are like recent introductions at a party. Too many in a short time looks thirsty. When you hear that list, you nod. When you live it, you discover where the quiet leverage hides. Payment history's secret is that the calendar is a cliff. Being 5 days late is bad for your late fee and relationship with the lender. It's invisible to most scoring models. 30 days late is where the cliff begins. At 30, the late becomes reportable. At 60 and 90, the bruise darkens. If chaos ever visits, your first survival rule is to protect the calendar line. Call, arrange hardship, make a partial payment if it secures a current status. Prioritize minimums over pride. A single 30-day late can drop a strong score by dozens of points and linger for years. 10 on-time payments will not erase it. They will surround it with context. The best secret here is boring. Put minimums on autopay from a bills account with a buffer, so your life doesn't narrate mistakes to bureaus. You can always add extra payments manually to kill balances. You cannot unring a reported 30 days late. Utilization is where most people donate points they didn't know they owned. Revolving utilization is calculated per card and in aggregate. Balance divided by limit. The model doesn't care that you paid in full before the due date. It cares what the lender reported on the statement closing date. That's the date to watch. If your card reports a $900 balance on a $1,000 limit at statement close, the model sees 90% utilization even if you pay it to zero a week later. High utilization looks like strain, even if you're rich and sloppy. The fix is simple and invisible. Pay your cards down before the statement closes, so reported balances stay low. Keep aggregate utilization under 10% if you can, and certainly under 30%. If you are using a card for big monthly spend and paying in full, move your paydown date to 3 days before the statement closes. You haven't changed your life, you've changed the snapshot the model sees. Limits matter because they set the denominator in that fraction. A $500 limit invites accidental high utilization. A $1,000 limit turns the same spending into a calm picture. Banks know this. They also know that higher limits often keep customers loyal and spending. The quiet win is to request periodic credit line increases on good standing accounts, ideally after you've demonstrated on-time payments and low reported balances for several months. Many issuers will soft pull your report for a limit increase. Some will hard pull. The strategic move is to ask which it will be before you request. A larger limit lowers utilization without requiring a behavior change. It is the only boost that can add points while asking you to do nothing new other than not using the new room to spend. Average age of accounts is the part of the score that resists shortcuts. You cannot grow a tree overnight. Closing your oldest card to simplify your wallet is one of the most expensive tidying habits in personal finance.
The score reads the closure as a future shortening of your average age when the account eventually drops off your report. The better move is to keep your oldest cards alive with a small recurring charge and autopay, even if you prefer a newer card for daily use. Downgrade annual fee cards to no-fee versions rather than closing them if the issuer allows product changes. You don't need to carry every card with you. You do need to keep your credit time machine powered on. Credit mix is often misunderstood as a command to collect loans. You do not get extra points for debt you don't need. The model rewards demonstrated competence with both revolving and installment credit because variety correlates with lower default risk. If life naturally includes an installment loan, a reasonable auto loan, a student loan you're paying as agreed, or a mortgage, your mix will reflect it. Do not take a small personal loan to diversify. That's a fee to impress a model that didn't ask. If your file is thin, just one card, consider a second revolving account a few months later, or a small secured installment credit builder loan with negligible cost from a credit union. The goal is not variety for variety's sake, it's a file that doesn't look brittle. New credit has two parts: inquiries and new accounts. Hard inquiries can cost a few points for a few months. New accounts can lower your average age and raise your risk profile temporarily. The secret banks don't advertise loudly is rate shopping windows. Many scoring models treat multiple inquiries for the same kind of loan, auto, mortgage, student, within a set window, often 45 to 45 days, as a single inquiry because the system expects you to shop lenders. That means the smart way to shop is with a timeline. Cluster your applications. Get pre-qualified with soft pulls where possible, then run hard pulls in a tight window for the real quotes. For credit cards, there is no rate shopping grace. Each inquiry stands alone. Batch applications sparingly and purposefully. A card you won't use is not a trophy, it's a future age problem. Collections, charge-offs, and medical debt behave like ghosts. Paid collections help some models, especially newer ones that ignore paid medical collections or certain small balances. Older versions don't forget as kindly. The rule that matters is current reality. If you have an active collection, negotiate in writing for a pay for delete with smaller collectors, or at minimum, a paid status with a letter confirming no further reporting. Never pay a zombie debt beyond the statute of limitations without advice. You can restart the clock accidentally. For medical bills, dispute insurance errors aggressively and request validation from collectors. Medical collections are often messy and fixable. The principle remains: choose your battles based on model behavior today, not on what a friend read 10 years ago. The Bureau's update, your strategy should too. Authorized user status, becoming a piggyback rider on someone else's old, clean card, can help thin files. The secret is selection. The account needs age, a perfect payment history, low utilization, and an issuer that reports authorized users to bureaus. A messy account can transplant mess into your file. Likewise, adding someone as an authorized user is an act of reputation lending. You are inviting their life into your snapshot. If you do it, set rules. No card is necessary. The value is the data line, not the plastic. Banks won't warn you that authorized user strategies can backfire when the relationship sours. Treat them like you would a co-signed loan, only with people you would trust with your inbox and your house keys. Disputes are not magic erasers. If an item is wrong, dispute it. If it is accurate and unflattering, disputing it frivolously can waste time and make real errors harder to fix because systems flag chronic disputers. The unglamorous secret is that many errors are mismatched identities, misapplied payments, or data lags. The fastest fixes come from the furnisher, the bank or collector who reported, rather than the Bureau's portal. Call, document, escalate politely, and ask for a correction at the source. Then follow up with the Bureau if needed. Be the most organized person in the conversation. Dates, amounts, screenshots, names, reference numbers. Credit reporting is a factory. The person who brings clean parts gets faster assembly. Utilization's cousin is individual card maxing. Even if your overall utilization is low, a single card reporting near 100% can cost points because it looks like you're riding a limit. Spread balances or prepay before the statement closes. If you must carry a balance briefly, carry small amounts across several cards rather than straining one. The model is a pattern recognizer. It dislikes the pattern of a cliff even on one account.
Installment loans have a utilization concept too, but it's gentler. The share of the original loan balance you've paid down. Heavily paid down installment loans score well. Ironically, paying a car loan off to zero can cause a small, temporary dip because a well-behaved line disappears and your mix shrinks. Do not let that dissuade you from paying debt. It is a blip on a number that matters less than cash flow. The long run likes people with money in their accounts and fewer claims on it. Credit limits you never asked for are a quiet tax. Issuers sometimes raise limits automatically. Sometimes they don't because your income is unreported. Many allow you to update stated income in the app. Doing so, honestly, can trigger a soft pull increase that lowers utilization. The bank won't email you that this is good for your score. They'll market the freedom to spend. Your job is to accept the denominator without feeding the numerator. Closing newer cards is less harmful than closing elders, but closures still rearrange your utilization math. Before closing a card that costs an annual fee, ask for a product change to a no-fee version. Keep the line alive, park a small subscription on it with autopay. If a card is a genuine temptation, remove it from your wallet, delete it from your browser, and leave the account in a drawer with a $4 recurring cloud storage charge. You are designing a relationship with a model and with your own impulses. Most households don't need fewer lines. They need fewer ways to swipe in moments of mood. Business credit is a separate ecosystem with overlapping parts. For small businesses and sole proprietors, many business cards don't report to personal bureaus unless you default. That means you can keep your utilization calm on personal reports by putting large reimbursed work spend on business cards. It also means you should never assume a business mistake won't touch your personal file. Personal guarantees and defaults pull pain across the line. Banks won't lead with that in sales copy. Read the terms. Decide whether you want the separation and whether you can honor the wall between business and personal uses. Hardship programs are not shameful. They are circuits designed into the house. If you lose a job or face a medical event, many lenders allow deferrals or interest-only periods that preserve a current status. Use them before you miss. The models treat a paid as agreed under modified terms note better than a 60-day late. Banks would prefer an arrangement to a default. They just don't advertise it loudly because they sell certainty. The secret here is timing and tone. Call early, bring documentation, propose a plan, ask explicitly how they will report during the hardship. Then set reminders. Hardships often require re-upping. Don't let the help turn into a future late because a calendar event slipped. Buy now, pay later plans have blurred the lines. Some providers don't report to bureaus unless you default. Others are beginning to report on-time behavior. The danger is fragmentation. 5 tiny loans at several vendors function like revolving debt in your life, even if the model doesn't penalize you yet. The bank won't stop you. The checkout flow is designed to convert. Your score might be quiet while your cash flow screams. The real rule is simpler than the technology. If a purchase requires debt to make it feel affordable, your budget has a different problem. Fix that, your score will follow. Credit scores interact with insurance and employment in ways that feel unfair. Insurers in many places use credit-based insurance scores to price risk. Some employers check reports, not scores, for certain roles. The secret isn't a hack, it's a timeline. If you know a check is coming in the next few months, lower your reported utilization aggressively. Let inquiries age past 6 months where possible, and clean small errors now. Rapid rescoring exists for mortgages when errors are fixed. It's harder elsewhere. The cheapest move is the same move. Make the snapshot boring at the moment it matters.
Identity hygiene prevents the kinds of mistakes that are not your fault but become your problem. Freeze your credit at all 3 bureaus. It's free and reversible. Use a password manager. Set up transaction alerts. Opt out of pre-screened offers if temptation is expensive. Monitor your reports with a free annual poll per bureau. Stagger them quarterly, or use the current extended free cadence if available. Banks would love a world where you accept their vigilance as sufficient. Be your own hall monitor. The model is only as honest as the data it receives. There is a paradox that banks don't emphasize. The behaviors that raise your score are the same behaviors that make you less profitable to them. Paying in full, using little of your available credit, avoiding cash advances, declining expensive add-ons, and shopping for rates in a tight window reduce your cost of money. Lenders earn most from revolvers who carry balances at high rates, from annual fees on cards with unused benefits, and from customers who accept the first quote. You don't need to be adversarial to win. You do need to remember that your incentives are not the same. Your score is a ticket to cheaper options. It is not a cue to consume more. If you are starting from scratch or from damage, the climb looks slow until it isn't. The fastest clean build is a secured card with a refundable deposit, used lightly and paid before statement close, a credit builder loan you set to autopay, and patience for 6 to 12 months. Add a second revolving line after the first ages a few months. Keep utilization under 10% reported. Put 3 small bills on autopay. Let time pass. Do not open 5 cards at once. Do not chase store signups for a discount. Do not co-sign because someone weaponized your empathy. Your score will move from thin to fair to good on a schedule that feels insulting and then suddenly sensible when you realize the model was waiting for you to prove you are boring. Recovering after a late or a collection is a 2-track plan: damage control and future perfection. On damage control, bring accounts current, negotiate deletions where possible, and write a goodwill letter after months of perfect payment to an original creditor if a one-time late had a credible cause: a move, misapplied payment, hospitalization. Some lenders grant mercy when the rest of your file is pristine and you've been a long customer. On future perfection, lock down autopay on every minimum, pay down utilization before statements close, stop applications, and let the clock build a halo around the bruise. Scores heal in layers. Lenders also look beyond the number. A thick file of current, calm accounts lowers suspicion even when a scar remains. The biggest secret is that you can have an excellent score and a terrible financial life, or a modest score and a calm one. You can optimize your number and yet be house poor, car-strapped, and one shock from revolving debt. Or you can carry no debt, miss a few optimization tricks, and still buy your freedom with cash. The responsible way to think about credit is as a cost-lowering device for money decisions you would make anyway at prices you can afford. A well-priced mortgage on a right-sized home, a reasonable auto loan when it beats cash deployment, a card that pays you modest rewards and protects your purchases while you pay in full. The number is not the goal. The number lowers tolls on your way to goals. So translate the model into 5 permanent habits. Put minimums on autopay, out of bills account with a buffer. Pay revolving balances before statements close so utilization reports low. Keep your oldest lines alive by downgrading, not closing. Apply in batches with a purpose and respect rate shopping windows for big loans. Build reserves and a budget that lets you avoid payment vacations that turn into lates. Layer on identity hygiene and polite persistence when fixing errors. Then ignore the noise. You will watch a 3-digit stranger stop bossing you around and start escorting you past expensive lines. Banks won't send you a congratulations letter when your profile becomes unprofitable to them. You will know because the world will start offering you cheaper money, and because you won't need it as often. The final perspective shift is to view credit as infrastructure, not as personality. Roads don't love you, they connect places. Use them when they shorten the trip. Walk when you can. Don't drive because the map app chirped. When you treat credit this way, you will check your reports on a schedule, not when panic visits. You will choose the simplest setup that prevents errors and preserves H. You will track utilization like you track your gas gauge. Glance, top up, and move on. And you will find that the real secret banks hope you don't learn is that their best customer is your past self, calm, organized, quietly predictable. Be that person for long enough, and the score takes care of itself.